good afternoon, and good evening to you, our listener, from whatever time of day you are listening to this episode of the Gspröch podcast series by Wyden, the digital asset infrastructure provider for regulated financial institutions. 2024 has been perhaps the biggest milestone year in terms of the crypto sector since its inception in 2009. Now, firstly, back in January 2024, the first Bitcoin-backed ETF gained approval by the SEC in the US, a landmark decision following almost a decade of rejected applications. There was then a flurry of new product launches, which sparked a price rally that sent BTC levels to levels not seen since its previous all-time high of 2021. All of this in a year when over 30 countries, including those in the EU, implemented new digital asset regulations designed to bring clarity to the industry and paving way for traditional market participants like banks, brokers, asset managers, and hedge funds alike to come to market and offer new products and services to their clients. We've already seen some high-profile announcements in terms of change and regulation by the new Trump administration since they came to power only a few weeks ago. By the way, we're actually recording this at the beginning of February 2025. That event took Bitcoin to a new high, but then again, we've already seen a huge dip wiping trillions off the value of crypto in early February from macroeconomic worries over potential trade wars with major US trading partners. So things are moving very fast, and they may get even faster or even crazier. So here to help us take in the macro view of events is Manuel Franceschi from the digital asset and next generation research team at Julius Baer. Julius Baer, as I'm sure some of you already know, has over 130 years of Swiss banking heritage and was the early mover into digital assets amongst Swiss institutions, having started out in this space in 2019. Manuel himself has nearly a decade of experience working in banking and digital assets, including 3 years in his current role at Julius Baer. He holds a master's degree in management and economics at the University of Zurich and a postgraduate degree in financial engineering from the Universidad Metropolitana. Thank you, Manuel, for joining me today. I really appreciate, and maybe we can kick off by you providing an introduction to yourself and for the great work that you and the team do at Julius Baer.
Thank you, Stuart, for having me, and it's a pleasure to be here. I work within the next generation research team where we assess on a top-down perspective these big structural trends that will change the status quo, that will change things as they are. And within this coverage, I take part in artificial intelligence, future of finance, automation robotics, cybersecurity, and essentially the blockchain space. On another note, we also cover on a bottom-up basis Bitcoin, Ethereum, and Solana. We have a rating on these tokens, and we try to give clients, at the end of the day, a rating and the most value added in terms of the research towards digital assets.
Fantastic. Well, I'm really pleased that you have joined today because based upon that, I think that you are exactly the right person I'll be asking these questions to get some great insights and informative answers for our podcast listeners. So maybe let's kick off with an easy question for you today to warm this up. So let's start off with one of the biggest events in the industry of 2024, ETFs. With nearly a year under our belt since the first Bitcoin ETF approval, can you share your insights into how the entry of US ETFs to market has affected trends in terms of institutional adoption?
That's a pretty interesting one. So absolutely, ETFs were the game changer of 2024. We had it on the 11th of January, the approval of spot ETFs on Bitcoin in the US, right? So we had spot ETPs in Europe for Bitcoin and other assets as well. But the US was a bit left out in terms of this better investment vehicle, because what we had before was either on a closed-end fund basis, had a tendency to trade at a premium or a discount to the fund's net asset value, or we also had some futures-based ETFs. And the problem with the futures-based ETFs is that investors ended up seeing a relatively strong underperformance against the spot Bitcoin prices. So ETFs were a success story on all measures, especially because they provided a much needed investment vehicle for long-term investors, for institutional investors that had been unable to invest because the lack of a high quality vehicle for them to enter the markets. And with that, we're seeing pension funds, we're seeing endowments, we're seeing potentially sovereign wealth funds, we're seeing family offices, and we're seeing really how the space is shifting and how the investor base suddenly realized the potential that an allocation of Bitcoin could have on a portfolio context when measuring the risk-adjusted returns. Whether it's the Sharpe ratio, judging for volatility, or even the Kalmar ratio that we've used for commodities in the past, where we measure for the maximum drawdowns. Right, so it's been a game changer on this end for us as investors, for institutional investors. It's also been a game changer for the asset managers themselves. And what I think is a pretty interesting success story is that for the franchise of iShares, they had net new assets last year of around 440 billion US dollars. And the Bitcoin ETFs brought in a tenth of these net new assets. So it's really shifting the way traditional financial institutions are attempting to play the space. It's a success story in itself with how many assets these wrappers managed to bring in last year. And as of now, the US spot ETF sits strong at around $120 billion in assets under management. And on another note, they've been bringing in around 150 million every day for the past 30 days. So that's pretty interesting what's happening, how these markets are growing quite fast and sometimes even fly below the radar, I would say.
That's a great answer. And I think that one of the things that's always been interesting about ETFs is they're not just a preserve of institutional investors, or they're not just a preserve of retail investors. They're a preserve of the market in that respect, both across institutional and retail. So how have you seen or any thoughts on the flow of capital from retail investors away from traditional centralized exchanges like Binance, Kraken, Coinbase, etc., to actually retail investors invest in ETFs?
I think there's no one size fits all. I think ETFs have their advantages. I think the other custody or investment avenues that we've had in the past have their advantages as well. And individual investors just have to maximize their need for liquidity, their need for custody, their need for delegating this custody maybe. So I think at the end of the day, we've seen growth in both sides of the equation. We've seen growth not only on the ETF side of things, but we're also seeing that some of the crypto exchanges, the centralized ones at least, have reported very high volumes in the past couple of months. And we're also seeing some of the, say, retail brokerage platforms in the US also reporting pretty high volumes. So I think it has benefited the space on a very broad basis, but I wouldn't be able to pinpoint how much assets are flowing in from the centralized exchanges into the Bitcoin ETFs, because that kind of data, I don't think there's anybody out there that can actually find it.
Yeah, no, absolutely. I think it'll be interesting in 2025 to see at the end of this year, now a number of very well-named banks will be going to market with a buy, sell, hold, closed loop offering retail services to their millions of retail customers, how much of capital they'll drag away from the centralized exchanges and also from the ETF market as well. It'd be interesting to see the trend, and maybe we could do this next year and see what the outcome was on that. But so far we've really just talked about Bitcoin ETFs, but if we move on to something like an Ether ETF, they seem to have had less impact. And is this really a function of lower market cap, lower liquidity, or do you think there are other factors in play that's not really growing the Ether ETF market like Bitcoin ETFs?
I think the number one hindrance of Ethereum ETF net flows or AUM, or however you want to see it, is Ethereum itself, right? So we've seen a market concentration into Bitcoin. We've seen Bitcoin's dominance continue to grow in the past couple of months. Ethereum is trading at around 2,800, which is really a level that hasn't demonstrated that much appreciation in the past handful of years, opposite to Bitcoin's rally that we've had in the past year, also since 2023. So I think Ethereum is the number one factor why Ethereum ETFs have had a slower pace in terms of the assets under management, in terms of the net flows. It's not as bad as it looks. It has picked up after the Trump elections because Ethereum is one of the assets more prone to be kind of disrupted and benefited by the changes in the regulatory and legislative environment in the US, right? So we expect that to happen. Nonetheless, the flows are not super impressive, and the performance of Ethereum itself hasn't been as impressive. Bitcoin has many angles, many indicators that provide value to it, one of which is the supply, right? So the supply essentially has been the comfort many investors seek when investing in Bitcoin. They know that the network will grow by around 200,000 tokens in 2025, in 2026, in 2027, and then in 2028, they know this is going to have eventually, right? So that gives investors comfort. So the inflation rate is fixed. It is growing in size, but this growth is decreasing, so it's disinflationary every certain number of blocks. In the case of Ethereum, we have actually that the staking emissions have not been offset by the burning mechanism that we had in the London hard fork. So essentially, the blockchain's supply growth has been 0.5%. Some call it inflation. You can call it inflation if you want. But that's essentially what's happened. So that's one angle that investors see as a caveat when investing, when being long ETH. So that's one of the reasons I think that Ethereum has been a bit, let's say, below the curve. On another note, you see the talks on Bitcoin's role in a portfolio context, and Ethereum's role in a portfolio context would actually be a bit different. So the volatility would have been a bit higher. The returns in the past couple of years, especially, would have been a bit lower. The drawdowns would have been a bit higher in the past couple of years as well. So it's really a different angle that investors must take when assessing if they find a role for Ethereum in their portfolio. At the same time, the reason why you would allocate into Ethereum in a portfolio context would essentially be to diversify your diversifiers. And that's what we're seeing. Investors have a tendency, or that's what we're seeing, to first allocate into Bitcoin in a portfolio and then allocate into Ethereum, if at all.
Now, that's a great, and I think I'd like to continue one point on diversification and risk, because traditionally everybody saw that even though Bitcoin or crypto was a risk-on asset, it was seen as a diversifier from a correlation perspective to other asset classes like equity or other asset classes. But that's not really been the case that we're seeing. We're obviously seeing trends where there is much closer correlation between traditional asset markets and crypto, or let's just use Bitcoin for this example. And where do you see that actually going? Do you see more correlation and more tightening, or do you see a decorrelation event coming?
So what's interesting is that when risk asset markets are trending, crypto tends to perform as a high beta play on many of the tech equities. When the market is ranging, the correlations tend to drop a bit. But yeah, that's a reality. And I want to make this very clear. For most of us, Bitcoin and cryptos, the value proposition is a bit different, right? But even though if we believe Bitcoin is a store of value, it performs as a risky asset within a portfolio. When we have a liquidity need, we will likely have to sell Bitcoin in order to pay back our credit card debts, auto loans. And that's also what we've seen in the past, right? So that's as simple as it is. I wouldn't want to complicate it any further. Some believe, that they would never touch their Bitcoin. And they've had Bitcoin for a certain number of years, and they will continue to do so regardless of what happens. In reality, if somebody has a liquidity need, they're likely to sell their Bitcoin in order or instead of getting an additional line of credit, which can range between 7 or 35%.
That's a very fair point. But if we look at, for example, institutional investors who don't have to repay their auto loans, do you see that they will see a correlation risk between Bitcoin and kind of equities or gold? Or do you still think they will see it as a risk on asset, and would they'll still take a certain portion of that, even if they have those other asset classes in their portfolio?
So I think at the end of the day, it's going to end up being determined by the investment horizon that the investors are having. How long are you willing to have Bitcoin an open position? How does the risk management work as well? What kind of drawdowns are you comfortable in managing? So it's an array of factors. In general, in my perspective, it has acted rather as a high beta play that exacerbates the equity movements when the market is ranging again. And it also has, the correlation is not perfect, right? So it also has a diversification component. And we saw it in the beginning of last week after DeepSeek's saga. Bitcoin was pretty much untouched, right? So there's been some situations when this has happened in the opposite direction. If we look back in the past 10 years, the largest drawdowns of the S&P, I think in 4 out of the 6 largest drawdowns above 9%, Bitcoin reacted more strongly than the S&P and the Nasdaq, drawing back even more than this. So you have to take it with a grain of salt.
Yeah, absolutely. No, good points. Wouldn't call it investment advice, but taking a grain of salt is obviously.
There's no financial advice.
Joking, exactly. That's the point. So, if we move on to sort of more specific factors around Bitcoin itself or crypto, as we know, 2024 was actually a halving year, an event that's traditionally been considered as a significant price action factor. However, it missed ongoing discussions about regulation and advancements in ETFs, for example. There seems to have been very little focus in the media and commentators amongst analysts on the impacts of halving in 2024. What are your thoughts on that?
I think the media attention has picked up brutally since the Republican sweep was realized.
Mm-hmm.
And essentially the media attention kicks off when the prices are a bit higher. Mm-hmm. In terms of the halving, I think first off, the approach we have to kind of assess Bitcoin's pricing and be able to give a directional recommendation or perspective to a client is we try to boil it down to 3 prongs. So the first one would be on the top-down conditions. So the macroeconomic and geopolitical ones, legislation. Second one would be on the supply side. The beauty about Bitcoin is that the supply we tend to know quite well. And we can also see when a certain wallet has interacted, has transacted in the past. And then we have demand. And demand is also pretty straightforward, let's say. In terms of the supply, I think the halving has been interesting on many prongs. My favorite one is certainly on this whole idea that the blockchain issues around 200,000 tokens a year to the miners, which as of current prices, that it's going to be around 20 billion. And the ETFs last year were buying an average of 10 to 15,000 tokens a week. So demand was essentially around 750,000 tokens, up to 1 million tokens from the ETFs alone. So that's what you call a supply squeeze. And you don't need to be an expert economist to realize the fact that when supply is kind of stable and demand is just growing at a faster pace, you're going to have some impact in the prices. And I think that's the big impact that we see. In terms of the halving, we are seeing a much more mature market today relative to the previous halving cycles. And I think the market's reaction, pricing-wise, has been effectively in order. We shouldn't expect these tenfold increases that we were seeing back in 2012, for example.
Is that a case of the maturing of the market in general, or is it the maturing of investors understanding the dynamics of this asset class?
So I think it's going to be both. I would lean towards your first suggestion as well. I mean, the market has really changed considerably. It's of significant size. Last year, we surpassed the market capitalization of silver. Market is growing. We're seeing 2 trillion in market capitalization for Bitcoin. And I think this is something that we should bear in mind. If you look at the order books in terms of the market depth, you're also seeing the size of the sell walls you need to go through in order to move prices up 2%. And it's way less in terms of what you would need to move prices down 2%.
Well,
So across all exchanges, and you have this data better than me, but as per my calculations in the beginning of the week, you need around 450 to 500 million to move Bitcoin prices up by 2%, whereas you would only need around 375 million to 400 million to move prices down 2%.
that's a very interesting insight. And I think one of the things you just touched on a few seconds ago was around sort of market centralized exchanges, and it's all around sort of liquidity, right? Because if you have a liquidity squeeze, then markets really react against that if you want to get out of a position. And we've seen pretty much with centralized exchanges in the past what happens in very volatile markets. So do you have any sort of insights in terms of liquidity trends and what this may reveal about how this space is evolving? And just for example, does the increasing involvement of the traditional financial institutions coming into this market, has that any impact on liquidity and the actual role of the traditional digital asset centralized exchanges and also other crypto native operators such as crypto brokers, of which there are quite a few who are very well respected in this market?
So what essentially we've been seeing on our end is that liquidity is just improving on a year-on-year basis. Like we're having better infrastructure, we're having better access, we're having, you just look at the growth in terms of the assets that exchanges are custodizing, centralized ones, the growth in the assets that the banks are custodizing. It's been a pretty interesting ride, and with that, you end up seeing improvements not only in the market depth but also in the spreads, and you're seeing spreads that are so good. Not only if you're trading the actual asset in some of the largest exchanges, but also when you're trading some of the other indirect investment vehicles. So when you're trading ETFs, you're seeing tightening spreads, you're seeing high volumes, and that's just a signal of a market that is just a bit healthier than it was a couple of years back.
Yes, I think that's very true, and I'd be interesting to see if we do this again this time next year, what is the impact of the the traditional asset players, particularly the banks. We know a lot of banks now have been applying for their CASP or VASP licenses. In now, like for example, in the EU, we know a number of them will come to market this year. Will be providing offerings predominantly in the EU around retail to their customers, and we'll be interested to see how liquidity profiles change. Particularly now, retail customers will be able to buy, sell, hold, all within the bank assurance of that bank, within that that nation's regulatory regime around bank assurance of assets and customer accounts. So it'll be really interesting to see how liquidity moves and where liquidity is actually being held and stored as well. But maybe I can move on to the next point, is around that we have all these favorable conditions, but still a lot of banks today are pretty cautious when it comes to crypto and crypto offerings. If we take, for example, Julius Baer, you even have your own digital asset research and advisory unit. Maybe I can kick off and ask, but why do you think Julius Baer took this step to actually really double down and actually be one of the early players into crypto and to offer these kind of services like research and advisory?
I think that's a pretty interesting one. I think at the end of the day, it's kind of part of our fiduciary duty to educate clients when they're trading something, to kind of give them our assessment on how the market is acting, on how we see things. So the thing is that essentially Bitcoin and cryptos, mostly Bitcoin became a global macro asset last year. When you start having these long-term institutional investors, Bitcoin ends up being affected by many other factors that maybe 10 years ago it was not affected by. So macroeconomic factors are playing a fundamental role. geopolitical ones as well. And at the end of the day, we just intend to give the fullest of pictures to the clients before just giving them a platform to trade on. So that's one of the reasons.
From our perspective, as viewers of the market, we see this as a very important part of the market dynamic, where a bank like Julius Baer does provide this research and advisory to its customers. And I think that can become even more fundamentally important. There is so much information in the market in 2025 compared to 2021 in terms of financial views, financial feedback, financial advice, financial forecasting, that one can get themselves lost in amounts of data and information, and dare I say disinformation as well. So having a trusted provider like Julius Baer, not just providing you with the trading capabilities, but also with trusted research and advice, must be a real comforting factor for your client base.
Agreed.
Good. So what about banks then, right? So in terms of banks wanting to meet that customer demand, is it in the longer term going to be okay for a bank just to position itself to offer crypto trading or buy, sell, hold services, and maybe therefore custody as well? Does the bank also need to start diversifying into other products and services like lending or staking products? Where do you see the market evolving for banks?
I think we are, in general, in expectation to see what's going to happen in the US. I think the US has had a tendency to set the tone in terms of what could happen, what will happen. It's also kind of the most material player in the risk asset ecosystem. So the US capital markets, in terms of equities, they have around 65 trillion in assets. Every single country in Europe put together would have around 12 trillion in assets. So we see this big discrepancy, and we see that what's happening actually further west in the US is what's going to impact the markets the most. Maybe it impacts prices first, and then it impacts kind of the viability of a certain project or so. So I think staking is something that we're starting to see more and more take place within some regulated financial institutions here in Switzerland. I would like to say as well that the FINMA has been quite advanced, kind of setting the tone relative to the rest of the world in the past. So yeah, I think just the capacities clients have are just improving. The depth of the product offering is also improving. And let's see what happens. But in the US, we are awaiting for many things to materialize. So we've had that a big part of the Trump speech last year was on crypto promises, because he realized, guess what? There's 50 million of crypto holders in the US, and they also vote, right? And at the same time, you've had political action committees like Fairshake becoming one of the key funders of the campaign. So it's in his best interest to keep his promises, to stay close to them. We've already seen the changes in the SEC in terms of regulation. So essentially, we saw Gary Gensler depart in the beginning of the year. We have Mark Ruyera as the interim chair, and we're expecting Paul Atkins in the near future to take the lead in the Securities and Exchange Commission. We saw yesterday how the SEC published a brief note on how they intend to tackle how their approach to the asset class will be. We're seeing a frenzy of ETF filings in the US for multiple tokens that have not fulfilled the pre-SEC, let's say the Gensler SEC requirements of having a futures market of sufficient depth and so on. So we're really seeing that the asset managers and the issuers are also expecting a lot of changes on the end of the SEC, which will only improve the number of investment vehicles and will also grant many investors much clarity that they wanted to have before entering the asset class. We're also seeing changes on the treasury side of things, with the potential lower taxes for some crypto companies based in the US At least that was part of the speech in the beginning. It has yet to materialize. We see Trump's appointment of David Sachs as a crypto czar, an AI czar as well, as an important part in the whole equation. Right. So there are many things changing. We also saw this custody bill, SAB 121, being revoked last week by executive order from the president that was essentially restraining some of the traditional financial institutions from custodizing the actual tokens. And there's a lot of things that could happen in the near future.
So do you think that's going to drop? Because most investors, particularly professional investors, they like volatility, but they also like trends and some form of certainty. So do you think that this change in volatility, not just in price, but in new announcements almost every week, revoking, changing, implementing, announcing, is that going to have a sort of short to medium term negative impact on market sentiment? Because not everybody knows which way the market is actually moving to actually in terms of a trend before somebody then jumps into a trend.
I think at the end of the day, we also have to wait for dust to settle. So Trump is in the office for less than a month. There's many things that are being touched upon. We have the Treasury on one end. We have the strategic reserve on the other relative to Bitcoin. But I guess the US has also a lot of other fights to fight. They have a debt ceiling in place since the beginning of the year, which actually affects their whole capacity for the government to finance itself, right? Essentially, there's two ways that the government can spend money, either issuing some debt or running down their Treasury General account. So I think there's many moving parts right now. And I think what would be the wisest is just, waiting for the dust to settle, understand the rules of the game. And this is what every single crypto firm in the US has been demanding from the SEC in the past. They just want to know the rules of the game to see what they can do and what they can't do. And at the end of the day, it's all net positive for the development of the industry, specifically in the US.
Absolutely. And although, we know that the US has always been one of the biggest or one of the biggest drivers in market dynamics and market economics. So we took our eyes off this, for a second, off the US specifically. And we look at, for example, at the Europe and also Middle East, and then particularly Asia, where there's not really been much movement over the last couple of years since the market downturn, since 3AC and FTX. Do you think there's any sort of industry regulatory developments that you're currently looking at or watching that could potentially have an impact on digital assets and crypto trends outside of what's going on in the bubble of the US?
Okay. In short, no.
Okay.
I mean, we're watching a bunch of things, right? I think the most material things are going to be happening in the US again. I mean, you look at the live streams yesterday for David Sachs' assessment with the chair of the Agriculture Committee and so on. There's so many people tracking what's happening there. The strategic reserve, stockpile, sovereign wealth fund related to Bitcoin has also stirred the pot quite a lot. I think that's been kidnapping the attention of Asians, Latin Americans, Europeans, Africans. Everybody is trying to see what's happening in the US relative to crypto. Besides regulation, because I guess it's a topic that to some might be a bit boring, include myself, I really like to assess as well the macroeconomic situation we have in the US. Right, so what's interesting is that the rates are still high. 425 is high. And it really, in my opinion, has also depressed investors' willingness to place a loan on chain and get a minimal spread on the risk-free rate, right? So that's quite important. But I am a strong believer that liquidity has driven risky assets as well since September, October of 2023. And for liquidity, we measure many things. The one I've realized that is the most meaningful for Bitcoin specifically, has essentially been the assets on the Fed's balance sheets net of some money that we think it's outside of the economy. So, for example, we take away the Treasury General account that we talked about before. That's essentially the Treasury's account in the Fed. We take away the reverse repo programs that we also had there, and we end up in a situation where if we look at today's levels and we look at the levels in June 2023, when the quantitative tightening program started, see that this program might as well have been sterilized. This net liquidity that we're checking out has been unchanged almost in this past almost 2 years, right? So that's pretty interesting. We've seen essentially complete sterilization of the QT program. And I think this has really driven the sentiment of risky asset investors, specifically Bitcoin investors.
Yeah, that's a really good commentary. I think that we've got a lot to see, as you said, more in conclusion, that we're still looking at the US, and that's been the main factor that we're going to be looking at what actually happens dynamically in the US this year. I still would like to think that we'll have one eye on, Europe, the EU, Switzerland, UAE with VARA, the new Turkish regulations coming out now as well. Hopefully we'll see some positive impact in the markets there and some growth from both mainly retail, but also institutional adoption. So, Manuel, the whole Wyden team and our listeners very much appreciate the awesome insights that you've given us today, especially as we're seeing a lot of current market movements and volatility since the inauguration of the Trump administration. In this case, everybody's looking for good information, intelligence, and guidance, and this has been a great help, I'm sure, for all of our listeners. I appreciate this takes time out of your schedule, and so we're truly grateful for the support you've given us for our podcast series. As ever, our listeners, along with our guest speakers, are the most crucial elements to making this podcast series a continued success. So please continue to spread the positive word if you like the content that you've seen today, and also of other previous podcasts we did way back in 2024, which seems like a long time ago now. Particularly, we've had the implementation of the Trump administration. We have a great lineup of guests and really interesting topics to cover over the next few months. So please look out and listen to the upcoming editions of the Gspröch. Enjoy your morning, afternoon, and evening from where you're listening to the Gspröch, and thank you very much.